Welcome to the deep dive.
Huh.
Today we're digging into a really interesting perspective on, well, handling the stock market when it gets pretty messy.
Yeah, we're looking at just one source today, right? An article.
Exactly. It's by Tony Hicks, published June 8th, 2025, and the title is pretty bold. The more it drops, the more I buy.
Catchy and provocative.
It is. So our mission here is really to unpack that, go beyond the title,
Get into the thinking behind it.
Yeah, figure out the logic and maybe see what insights you can take away for dealing with volatility, especially when everyone else is kind of freaking out.
Because this piece really, it challenges that gut reaction, doesn't it? Seeing red in your portfolio and just wanting to run.
Totally.
It flips the script, suggests maybe falling prices aren't a disaster signal. Maybe they're an opportunity signal.
They'll signal to lean in.
Exactly. So we'll explore why the author sees opportunity there and, what kind of mindset, what kind of discipline it actually takes to do that.
Okay, so let's set the scene. The author does it really vividly. Imagine the market is just tanking.
Ugh, red candles everywhere.
Right, the kind of day where checking your brokerage app feels like, I don't know, walking into a haunted house.
Yeah, most people, instinct is scream, run for the exit.
But the author paints himself as the lunatic walking into the haunted house.
He sees the free fall and things.
All right, fire sale.
It's that immediate contrast, isn't it?
Definitely. And the core mantra, like the title says, the more it drops, the more I buy.
So simple to say, but emotionally, wow, that's tough.
And he's clear, this isn't like a tiny dip we're talking about.
No, not just a wobble.
He means those serious gut-wrenching drops, the kind where your neighbor is suddenly talking about trading his 401k for canned beans.
Or CNBC's running Dow bloodbath headlines.
Less. Or your Uber driver, who you didn't ask, tells you they've gone all cash.
That's the signal. That level of panic.
That's his cue. He calls it joining the Contrarian Club.
Which sounds lonely. Yeah, probably is. He says it's not glamorous. You get strange looks. People asking, are you okay?
Maybe suggesting therapy? Gently. Yes. It means buying when sentiment is just abysmal.
And he uses the classic example, right? Buffett.
Of course. Warren Buffett, 2008, financial crisis melting down, banks failing, pure fear.
And Buffett wasn't selling?
Nope. He was writing that New York Times piece, Buy American, I Am, and famously putting billions into Goldman Sachs.
Right when everyone else thought they might go under.
He didn't wait for the all-clear signal. He acted because of the fear.
Okay, but that immediately brings up the big question, the one everyone has.
The elephant in the room.
Okay, fine, buy the dip, but what if it just keeps dipping? What if I buy and it goes down another 20%?
Right, that's terrifying. It feels like you made a mistake.
And the author tackles this head on. He says, yeah, it might keep dropping.
Yeah.
And that's not a sign the strategy failed. That's actually, and this is his phrase, where the magic is.
Magic. When my portfolio is bleeding, how is that magic? Explain that.
It's a total reframe.
Yeah.
The magic is that the continued drop lets you buy even more shares of those same good assets at even lower prices.
Okay. So while everyone else just sees loss,
the contrarian sees repeated chances to lower their average cost, to build a bigger position cheaper.
He uses that analogy about shoes, right?
Yeah, the favorite pair of shoes. If you love them and they suddenly go 30% off,
you don't panic and throw out the pair you own.
You buy more, maybe a couple of pairs.
So why do we react the opposite way when a stock we supposedly like goes on sale?
Exactly. It shows how emotional the market gets, which leads to that fundamental point he makes.
Price versus value.
Price is what you pay, value is what you get. Crucial distinction.
Especially in a downturn. Because the price tag dropping doesn't automatically mean the thing itself is worth less.
Precisely. A good company's stock can plummet just because the market's having an emotional breakdown.
Panic selling, margin calls, fear.
Right. That drives the price down. But the value, the actual business, its products, its earnings power might still be perfectly fine or even getting stronger long term.
And the author sees that gap, that disconnect, as a gift.
Yeah. And he uses examples we all know. Amazon, Apple, Netflix.
Oh, yeah. They've all had huge, scary drops in their history.
Massive drops. Times people wrote them off. But the underlying businesses were strong.
They had that value.
And investors who focused on that value, who bought during the panic, they saw incredible returns later because they bought based on value, not fear.
So the takeaway for you, the listener, is if you believe in the business, its model, its competitive edge, its ability to make money,
then a lower stock price shouldn't be scary. It should be
interesting,
maybe appealing. It's a discount on something you already value.
Okay, but still, isn't the dream to nail the absolute bottom, buy at the perfect lowest point?
Yeah, the author basically says forget it.
Really? Just give up on timing.
Completely. He says flat out, no one times a bottom consistently. Anyone claiming they can is probably selling something or just got lucky.
Trying is like, what was the analogy? Jumping on a moving treadmill blindfolded.
Something like that.
Yeah.
Point is, you'll probably just hurt yourself.
Okay, so if perfect timing is out, what is the goal then?
It shifts the focus. The goal isn't timing. It's consistently buying good assets at better prices.
Building a position over time.
Exactly. Lowering your average cost per share bit by bit. And trusting that long-term, good businesses and the overall market tend to go up.
Which brings us to the practical tool for this, dollar cost averaging, DCA.
The unsung hero, yeah. He admits it's not sexy.
Not like crypto or meme stocks.
Definitely not. But he calls it discipline, sanity, wealth building in slow motion.
Slow motion. But it works. How does it become a secret weapon during a crash specifically?
Because it's automatic. Your fixed amount of money, say $100 a month, buys more shares when the price is low.
Ah, right. While everyone else is scared, your regular investment is actually working harder for you.
Exactly. You're automatically accumulating more ownership when things are cheap. I love his framing. Recession. Sweet. More shares.
Bear market. Delightful.
Volatility. That's my cardio.
It flips the negative into a positive. But doing that, acting like that when your friends, family, the news, everyone is screaming, sell, now that's got to be tough. Socially.
Oh, hugely. He has a whole section, The Herd Will Hate You.
Doesn't mince words.
No. Because seriously, when people are watching their savings evaporate, the last thing they want is your cheerful buying the dip story.
You'll get sneered at, mocked.
People will quote Buffett back at you, ironically, right before they panic sell.
And you'll definitely hear that phrase, it's different this time.
Always. Every single time.
Yeah.
And his response is blunt.
Yeah, it's always different.
Yeah.
Until it isn't. Until the market eventually recovers like it always has before.
He even maps out the cycle, doesn't he? How this plays out every time.
Yeah, it's pretty spot on. Market crashes, people freak out, news gets hysterical, you buy nervously, market stays down, maybe goes lower, you start questioning your sanity, news declares capitalism dead.
Uh-oh.
But then, quietly, things get better, stocks creep up, then they rally.
And eventually, the people who sold in a panic or waited forever for clarity, they start crawling back in, usually at much higher prices.
While you, the contrarian, have just been compounding because you bought low.
And later, people ask, wow, how did you know? And the answer is,
you didn't know. You just had a plan and the stomach for it.
And maybe, as he says, a little bit of spite to prove the panickers wrong.
Haha. He uses March 2020 as the perfect recent example.
Textbook case. Pandemic hitting, lockdowns, total uncertainty, toilet paper wars.
And the market falling like a rock tied to another rock. His words. Headline screaming, unprecedented.
And what did the author do?
He bought.
And when it dropped more?
He bought more. Leaned right into the mantra. The more it drops, the more I buy.
And the outcome, we all saw it. The S&P 500 roared back faster than almost anyone expected.
Lots of stocks doubled, tripled, quadrupled.
While the people who waited for things to feel safe again, they maybe bought back in 30%, 40% higher.
Paying way more for the same burger just because the chef stopped yelling, like his other analogy?
Exactly, which underscores his point that this approach, it isn't for everybody.
Yeah, he's very clear on that. This isn't for everyone.
Requires a specific kind of temperament.
Definitely. He says it's not for, well, he uses the word cowards.
Blunt.
Also, not for people compulsively checking your apps or who hit the sell button the moment things look scary.
So who is it for then?
It's for people who understand volatility isn't a mistake. It's the price of admission for potentially higher returns.
That fear is a feature, not a bug.
Right. It's for people willing to be uncomfortable, willing to look wrong, maybe for a while.
Because, as he argues, the really great long-term results don't come from comfort. They come from courage, conviction.
And maybe a little bit of crazy.
Which ties into that idea about how the market behaves short-term versus long-term.
The voting machine versus the weighing machine. Classic concept.
Yeah, he uses it well. Short-term, market's a voting machine, totally emotional.
Chases headlines, hype, narratives, gets drunk on greed, hungover on fear, overreacts constantly.
But long-term, it becomes a weighing machine.
Rational. Focused on fundamentals.
Earnings, dividends, cash flow, actual business value, it weighs the substance.
Oh, so the strategy connects here.
Yeah.
The big drops are usually the voting machine freaking out.
Exactly. And that panic is the signal for people who trust that eventually the weighing machine will recognize the real value again.
Okay, so if someone's listening and thinking, all right, maybe I want to be that lunatic walking into the haunted house, what are the practical steps? The author gives a kind of playbook, right?
He does. It's pretty concrete. First, build a watch list.
Know what you want to buy before the sale starts. Quality companies, maybe ETFs you understand. Look for profits, competitive advantages, moats.
Second, know your value. Don't just buy blindly because it's down. Do some homework. Use valuation metrics, price to earnings, price to book, whatever works for you, to have an idea of what a fair or good price range is.
Third, set buy triggers. Decide ahead of time. If stock X hits this price, I'll buy this much. Based on your analysis, not just gut feeling on a bad day.
Fourth, and maybe the most important for consistency, automate DCA. Set up those recurring buys, takes the emotion out, and then be ready to add more manually during the really big dips.
Fifth step, turn off the noise. This is a hard one.
It really is. Stop watching CNBC all day. Stop refreshing your portfolio every 5 minutes. It's not a soap opera. You're building wealth slowly. Tune out the drama.
Sixth, stay liquid. Keep some cash ready. Dry powder, as they say.
Because you can't buy the fire sale if you don't have any money. Crashes are opportunities, and cash lets you seize them.
And the last one, review, but don't react. Check in on things, maybe quarterly or annually. See how your plan is working. But don't constantly tinker. Don't overtrade. Let compounding do its thing.
It's a solid framework.
It really circles back to that core message, doesn't it? Fear is loud. Fear sells. Panic is contagious.
But the real advantage, the edge, comes from seeing through that noise, recognizing widespread fear not as a stop sign, but as a potential signal.
The signal of value might be appearing.
Buy when there's value. Buy when others are terrified. Buy especially when everyone is screaming, this time is different.
And if someone asks you during the next inevitable crash, what's your strategy? The answer from this perspective is simple.
The more it drops, the more I buy.
It's a powerful idea.
It really is. Intellectually, this perspective offers such a clear, logical way to frame market drops as opportunities tied to value.
Makes perfect sense on paper.
But, like we've been saying, actually acting on it. That means staring down some serious fear, uncertainty, and doubt. Going against the crowd is hard.
So it kind of leaves us, and leaves you, with a big question to chew on, doesn't it?
I think so. How do you actually cultivate that emotional strength, that fortitude you need to be contrarian when everyone around you is losing their minds?
Is just understanding the logic enough?
Or is the real deep dive, the real challenge, mastering your own reaction, your own fear, your own response to seeing red? What does it really take to be greedy when others are fearful?
That's definitely something to think about. A powerful place to end. That wraps up our deep dive into the more it drops, the more I buy.
We hope it gives you maybe a different way to think about those inevitable down days in the market.